This chart is an example of why many traders struggle during the market open. When price action is completely buried under overlapping neon lines and indicators, it creates conflicting signals that lead to hesitation. To find clarity, we have to remove absolutely everything. Deleting the RSI, MACD, and VWAP reveals the underlying price movement. With a clean chart, we can apply the first candle strategy. This is a mechanical three-step system designed specifically to trade the volatility of the 9:30 a.m. Eastern Standard Time open. Reducing the chart to its basic elements makes it possible to recognize the same opening patterns every day without the distraction of secondary indicators. The process begins by setting your time frame to 5 minutes and waiting for the New York Open at 9:30 a.m. You must let the very first candle fully form and close. This takes 5 minutes, meaning you won't take any action until 9:35 a.m. You draw two horizontal lines, one at the absolute top of the wick and one at the bottom. The area between these lines is your opening range, acting as a barrier for the morning session. These physical boundaries provide an objective framework for your decisions. By defining the range early, you establish clear rules for when a trade is valid and when the market is simply moving sideways. Once your levels are marked, drop down to the 1-minute time frame. This is where you will watch for price to break out of the channel. A directional confirmation requires a 1-minute candle to physically close its body outside the boundary. A wick poking through signals a trap. We need a full-bodied close. Waiting for that structural close on the 1-minute chart helps filter out the initial spikes in volatility that often reverse. When the breakout candle closes, the common reaction is to enter immediately. However, buying or selling at that peak often puts you at the end of a move. Instead, we wait for a retest. The price arches back down to touch the horizontal line it just broke. The entry is executed the moment price touches the line and shows a rejection. You can choose to enter aggressively as the price touches the line, or wait for a secondary confirmation candle to close as proof that the level is holding. Entering on the retest allows you to place your stop loss much closer to the entry point. This tighter risk profile improves the mathematical efficiency of the trade. This risk-to-reward block shows the target math. We set our take-profit level to double the distance of our risk, maintaining a fixed 1-to-2 ratio. A common mistake is placing a stop-loss exactly on the range line where normal wicks hit it. To prevent this, we move the stop-loss down to a structural low, giving the position room to breathe. If stopped out, look for a reclaim. The price forcefully crosses back above the horizontal line, triggering a second entry with a new stop-loss placed directly below the reclaiming candle. Identifying a reclaim pattern allows you to identify a high-probability second-chance entry, even after an initial loss occurs. The sequence is always the same. Mark the range, wait for the 1-minute close, enter on the retest, and manage the risk using structural levels. Look at how these steps appear in a real SPY execution. The initial range is set, the retest provides the entry, and the price climbs steadily until it hits the 1-to-2 target line. Tomorrow at 9:30 a.m., pull up a blank chart. Draw your lines and track the price action through these steps to see how the market reacts to the opening range. Following these mechanical rules provides a roadmap for the first 90 minutes of the day. When you know exactly which candle triggers an entry and where your exit sits, the market open becomes a series of data points rather than a source of stress.